All right, all right, all right. Hope you guys are having a great day. This is Rosario, financial planner and MBA here at Red 7 Wealth Management at Escondido. And this is really geared towards our retirees. Just a quick little video I wanted to put together. And this is really guiding your retirement, a few key things to watch out for, three main points, in fact, which is why ages 59 and a half to age 65 are really the most crucial in your retirement. So there's a few main things that a lot of people don't consider that we kind of want to just take some time to educate you guys on, retirees or people who just want to get educated in general on going forward. So first and foremost, the main three dominoes that we're going to tackle today is what happens at age 55. Well, besides maybe like your knee joints and things like breaking down and stuff like that, the main thing that happens at age 55, one of is your 401k in your retirement accounts are now accessible without a 10% penalty. And I want to explain what that means. People get a little bit, I think, confused occasionally sometimes and say, well, a 10% penalty, but do I not pay tax? So imagine you have a 401k from an old employer that you rolled into an IRA account, a individual retirement account. Prior to 59 and a half, besides a few exceptions that we're not going to get into today, you will pay earned income of whatever that is, approximately 24%, give or take. The 10% California tax, again, these are rough figures, and a 10% penalty on any funds you take out of this account prior to age 59 and a half. Once you hit 59 and a half, the 10% penalty is waived. So if you owe a normal, just traditional retirement account, now all you owe are income taxes on dollars you take out of that portfolio. If you own what's called a Roth IRA account, which essentially you paid after tax dollars with, you let it grow, every single penny of those dollars is now tax-free. So there's no 10% penalty. In addition to that, there's also zero tax implications. So that's the first domino that falls. To be aware and to let you know, distributions inside of these accounts or trades inside of these accounts do not pay taxes. It's when you physically pull the dollars out of the account. So the 10% penalty for early withdrawals is waived at 59 and a half. So that's one domino. Second of all, and this is a big one that I kind of want to go over more, and a lot of clients have questions on, is Social Security. And next slide, I'll explain this a little bit more. I don't know if it's necessarily healthy to get passionate about this, but for one, I genuinely do. So here's a couple of things. The earliest you could receive a Social Security benefit is 62. Latest is age 70, right? In your full retirement age is age 67. Now, if you collect earlier at 62, there's a catch. We go, hey, you could collect at 62, but you only get 70% of the amount that you would have received if you collected at age 67. On the opposite amount, Social Security, the trust is kind of running out of money. That's a whole other debate that's kind of getting into politics. But every year you wait past age 67, you will get 8% more for every year that you wait. So here's a little diagram I came together with. I'm actually proud to say I built this myself. I didn't use ChatGPT, so that's pretty dope, you know? So for starters, right, and we'll look at the Social Security benefits broken down. This kind of takes into account of what I'm discussing, right? So for example, if you're age 67 and your benefit is 3,000, you would get 3,000. Every year before 67, if you notice, you get roughly, again, rough figures, roughly 7% less every year before 67. This is the monthly benefit and this is the total benefit, okay? And that's a for life benefit. And Social Security uses something what's called chained inflation, basically. And essentially it inflates, but it doesn't inflate like cost of living adjustment. We'll call it like a flat 2% inflation, give or take. So these numbers also inflate for life. So to be honest, there's not really, again, this is where we talk with clients. And when I say a lot of this is just education, there's not right or wrong answers. Here's why, is that if you look at this, some people, there's a certain break-even point. It generally occurs in your 80s, where if you wait until these later ages, you will out earn uh, collecting earlier, right? Now, some people, they go, Rosario, I don't care about breaking even at, say, age 82, 83. You know, and you never know kind of where life takes us. Only God knows, right? And, I have an early history of death in our family. And therefore, I kind of want to just collect right around here. I'd rather get my hands on those dollars now than later. Other people, they go, hey, you know what? My mom is 98. My dad is, 99. We got longevity in this family. I'm going to wait until age 70 and I'm going to collect that, $44,000 a month benefit or 44,000 a year benefit rather than that 25,000. So that's one thing. And then there's also what's called spousal benefits. And basically, this varies case to case, but if your spouse, let's say, for example, you're at age 67 and your spouse is entitled to the higher of their own benefits on what they earned, or your spouse is entitled to half of your Social Security benefit at full retirement age. So, for example, if your spouse never paid into Social Security, and let's say, for example, your age 67 benefit for retirement age was 30,000, they are entitled to a $1,500 a month benefit. And they are entitled to, basically, it's a pick and choose, the higher of their own benefit or the higher of that spousal benefit. So going on is some people try to circumvent the system. I'll kind of tell you guys why this doesn't necessarily work. Is they'll say, well, Rosario, I'm going to circumvent it. I'm going to work until 65, 66. Take all of these payments every month and invest it. Here's why you can't do that. And this is interesting. There's the government always wins. Is that if you are under full retirement age, Social Security says, hey, at a super, super low threshold, guys, any earned income that you make beyond for 2026, 24,480, we are going to take away $1 from your benefit payment for every $2 you earn above this annual limit. So what does that mean? It's basically saying, hey, before your full retirement age, so 67, unless you're working some part-time job at your church or at Home Depot that's under this limit, essentially Social Security is going to go, hey, you can't double dip on those. Otherwise, 50 cents on every dollar, we're going to take away your Social Security benefits. Now, once you hit age 67, that provision goes away, meaning you can make $250,000 a year and still collect on your Social Security benefit of, for example, $3,240 a month, not see any reduction. So those are the two kind of, you see these ages. So first stepping point is 59 and a half, accessing those accounts penalty free. Second is age 62, you could start getting your hands in on Social Security, right? And this is general advice. Other people may have pensions, other sources of income. Maybe you have a rental property, right? But that's one thing that is kind of the backbone of a lot of retirement. That's point two. And number three, and this one is the unsung hero a lot of people don't know, is they go, Rosario, none of my friends, why do I keep hearing this age? If I could access at 59 and a half, collect at 62, why do I keep hearing age 65? My buddy is postponing till age 65. Sue is postponing till age 65. Why is that a magic number? And it all has to do with healthcare costs and basically how expensive it is to insure private healthcare costs before you go to the public market. So let me explain what that means. Is that once you hit age 65, you qualify for what's called Medicare, right? And Medicare essentially gives you a hugely reduced medical costs, of course, once you hit age 65. Um, Typically, people get healthcare costs through their employer, give or take. But if you retire at around age 60, 61, 62, 63, on average, a healthy 62-year-old couple can expect to pay, and this is nuts, 2,800 a month in healthcare costs. So that's why you see that's a drag upon your portfolio in those beginning years. So that's basically saying, hey, I have to effectively take about $34,000 out of my portfolio during those first few years because I don't get Medicare, I don't get health care, right? Once you hit 65, Medicare costs are significantly more inexpensive. And I would rather, this is educational, so I don't want to be giving exact quotes, but that's the third domino. And that's why you see a lot of people postponing those few years, contributing to a 401k, and then getting, eking a little bit more into their 401k and waiting until 65. We at Red 7, we see it all the time with our clients. So kind of to wrap this brief webinar or education session, whatever you would call it, if you're even this far, is this where this fundamentally all comes together is your financial plan. It doesn't have to be complicated. There is no right or wrong answer. This is just math, right? And some people would say, hey, I'm fine retiring earlier and living off of a couple thousand a month extra. Other people say, I want to live it up. I'm going to either save a lot more now, maybe invest a lot more aggressive, or postpone retirement a few years because in those years I want to live it up. And that's kind of really where the financial planning process comes in and how we ultimately feel like we help our clients is every situation is different. Some people living off of 8,000 a month might be more money than they ever need. Other people might say, no, I need much more than that. And really, there's no right or wrong answer. It's kind of just us running the numbers, sitting down for that financial plan, and really just educating you on those options. So that's ultimately the end of today's, I don't know what you would call this webinar education session. I do enjoy this a lot, but if you're interested in chatting with us, please, book below. We'd love to sit down and kind of run you a personalized financial plan. And I hope you at least gain something with some brief education pertaining to this and gain some things. So have a wonderful, wonderful day. Thank you so much.